when you're looking at the unit trust to see have they been consistent in the returns they've been publishing. So you want to invest somewhere there is consistency. Consistency does not obviously show what the future will hold, but it does give some level of credibility. So important to invest in somewhere where there's been shown that there is consistency of return. Second thing is looking at past performance, and as well this sort of touches on consistency of returns, but also you can always request any of these unit trusts to share with you their fact sheets. The fact sheets show their past performance. Their past performance gives an indication of what the future could be. Well, not exactly, but if someone has done well in the past, there is an assumption they already have the experience to be able to generate returns now and into the future. So it's very important for investors to evaluate fact sheets. Most fact sheets are sent on a monthly basis, others on a quarterly basis. So very important investors to take into consideration and reading these fact sheets and getting a better understanding where you can get guidance from RMs. For instance, in Nabo Capital, we have dedicated relationship managers who can take you through our fact sheets, help you to understand every part of the fact sheet so you can better be informed and better make investment decisions. Third thing is just to understand what are the fees charged. So different fees are charged on various unit trusts, and so it's important to know, is there an initial fee that is charged? What is that initial fee charged? Is there management fees that is charged? If there is, what's the management fee? And also understanding if there is a redemption or an exit fee. Also, because over time these fees tend to accumulate and could eat some of your or reduce some of your returns over time. So very important to understand the fees that you're charged, and also important to understand certain key terms. So there's key terms around gross fees, gross, which is means without fees, and net of fees, which is already including fees. So for the most part, important for an investor to understand what is the net fees. What return am I expected to get after deducting fees? So always ask that question, what is my net fee, as opposed to asking what your gross fee is, and also understanding the specific fee element that is charged on each unit trust, so you can best be able to understand the unit trust which you are investing in. Going into step 6, like to focus on diversification strategies, and one of the key diversification strategies is looking at a geographical diversification. So that means that you're investing in unit trusts that offer you different investments that are located in different geographical areas or locations or countries, which reduces the risk of one single economy. And for instance, Nabo Capital, through its USD unit trusts as well as its equity and balance fund, are invested in different countries across Africa. So that offers you that diversification benefit, given that it's not only solely invested in Kenya. So if there is a significant risk in Kenya, the risk is mitigated by the investments we've made in other countries, in North Africa, in West Africa, in Southern Africa. So it's important for investors to look at, when they're looking to diversify or mitigate risk in their portfolios and in their investments, to focus on some element of geographical diversification. Second is to look at currency diversification. We're in an era where we've seen the dollar appreciate quite significantly relative to various African currencies, various emerging and frontier market local currencies. And so we're at that point, or that juncture, where diversification of currency is very important. And so as an investor looking to reduce the exposure or reduce the overall risk, they should look at, am I invested just in one single currency, or is there a benefit to me investing in other currencies, say the USD? For instance, Nabo offers and has offered for a long time the USD unit trust, both in the money market for short-term investors and the fixed income for long-term investors. So you get that diversification benefit for the fact that if the shilling depreciates or loses value relative to the dollar, then your investment is growing more by investing in the dollar currency. And also you get some diversification from the Kenya shilling, given the Kenya shilling offers a higher return on a nominal basis compared to investing in the USD return. So looking at currency diversification is quite important. Third is looking at time horizon. Time horizon basically is looking at it from a short-term versus long-term perspective. So if you want to invest for the short-term, preferably, as I've mentioned before, a money market fund is most suitable. If you want to invest long term, and how we're looking at phrasing these ones is short term is less than 1 year and long term is greater than 1 year. So if you're looking to invest for the short term, money market is most preferable investment, and for the long term it's investing in the fixed income, investing in a fixed income unit trust. So you can have different buckets of your investment, as we've noted, and when you have those different buckets, you might have, for instance, an investment you're looking for to invest in a trip in the short term, or you're looking to invest for your child's school fees, which is a long-term investment. So you could have a situation where you have a short-term investment and then you also have another bucket where you're investing in the long term. So very important to consider time horizon as a factor. And lastly is when it comes to looking at diversification strategies is asset classes. I've talked about asset classes, but now when it comes into specifically as a diversification strategy, you could have a balanced approach where you want to invest in fixed income as well as get some benefits from investing in an equity fund. So equity fund could offer you potentially high returns at a high risk, but a fixed income fund could balance that off by giving you regular income at very low risk or lower volatility. So good as an investor based on assessing your goal, assessing your risk tolerance, and seeing where that fits, to consider that asset class approach when it comes to diversification. Do I want to put all my eggs in one basket and be fixed income, all my eggs in one basket, equity, or you can have a balance of the two, and also determine what type of sort of allocation do I want. Do I want a 50-50, 50%, 50% sort of balance? Do I want more skewed towards 70% being fixed income, 30% equities, or the inverse of that, where you kind of want 30% in fixed income and fixed income fund, 70% in equity fund? All again, that is possible, but again, very important to assess yourself as an investor and ask yourself, is this the sort of strategy I'd want, and will it deliver the outcome that I find most suitable? So going now to sort of the last strategy around that is communication, and communication with your investment manager or with your unit trusts as an investor. So it's very important as an investor to ensure that you're communicating on a regular basis with your unit trust management. In this case, if you're invested, let's say in a money market fund or a fixed income fund, to communicate with your relationship manager or to communicate to the portfolio manager in charge of that fund to see, are you heading in the right direction? Because there are so many things to look at when you're assessing whether you're on track or not, and important to monitor and evaluate, am I heading in the right direction? You could have invested, say, at the beginning of 2023, and now we're in November 2023, and can you, as an investor, you should be in a place and say, I am happy with where my returns are, or I am unhappy, and these are the things that I have done to adjust that. But if you're in a place where you're sort of in limbo, where you don't know exactly where you are, you don't know if you're succeeding or you're failing, then you're in a very sort of precarious or difficult situation. So it's very important as an investor to always communicate with your relationship manager. Engage with them through the reports that they send you on a monthly or quarterly basis. Have a call with them and get to understand, are you meeting your goals? Have a clear target of what you want to achieve when investing in these unit trusts. And based on that, they can be able to either rebalance your portfolio. Let's say you expected equities in this particular year to perform well, so you invested quite a lot. Let's say 70% of your investment was in equity fund and 30% in a fixed income fund, and currently you're making losses on that equity fund and you're not happy with those losses as at now. So it's very good to engage your relationship manager, engage the portfolio manager and say, I'd like to be adjusted. In this case, I'm not happy with what's happening on the equity fund and you'd want a shift. So that could be done where now you move, let's say 50-50, from 70% to 50% in equity fund or even more into a fixed income fund that is more stable, that generates income, that is less volatile, less risky. So all again, very important to monitor your portfolio as frequently, I'd say as monthly or at most quarterly, no more than a quarterly basis. And also very important for you to communicate directly to your relationship manager in regard to your investments. And that's what we do here at Nabo Capital. For each sort of client is attached to an investment or a relationship manager who can now sort of guide you when it comes to this, when it comes to such communication. And I think just closing us out in regard to everything that we've discussed today, it's very important to diversify your portfolio. Diversification is one of the key elements of any investment strategy, and it's very key when it comes to reducing risk, because you want to generate a high risk adjusted return. You don't want to take too much of a risk and very low returns, but you want to just make enough return that meets your risk requirement. And just to know that there is no investment, no single investment in this entire world that has no risk. Each investment, be it in property, be it in equities, be it in fixed income, be it in bank deposits, be it in cash, be it in a money market fund, there's no investment that does not have risk, but each investment has a level of risk. So it's very important to consider diversification within when you're investing in unit trusts, and considering particularly important just two things that I started out with: understanding your investment goal and understanding your risk tolerance. And I think once you've understood that, you'll be in a very good place to choose your type of investments, and you'll be in that journey to invest, as we say, invest with purpose here at Nabo Capital. So thank you very much. Once again, my name is Charles Miano, Senior Associate at Nabo Capital.
That's what we do here at Nabo. I encourage you to go back. We have a wealth of videos that have been done before. Share this video with someone who needs it. And also remember to leave us a comment. And if you have any questions, just leave it behind and we'll tackle it in the next video. Thank you and God bless you.